Today's video looks at why your portfolio should consider investing in global property, which can be achieved through a simple vehicle such as an exchange-traded fund, or ETF as it's often referred to. Spider ETFs by State Street Global Advisors have invited Tim Mackay, a financial advisor at Quantum Financial, to speak to us. Tim, thanks for joining us. We hear a lot about why investors should look at investing offshore in shares. Why should they look at global property?
Thanks for having us here today, Paul. When it comes to investing in offshore property, there are three main reasons. The first is getting exposure to some great overseas markets. So predominantly US we're talking about here, but also the Japanese markets and some of the European property markets. The second is for a lot of people who are seeking yield, those that are in retirement or approaching retirement, the yield that property investments can throw off can give them the income that they're after to support their lifestyle. And the third one is diversification. So clearly, most investors will already have exposure to equities, international potentially and domestic equities. So that additional exposure to commercial property and international commercial property gives them that diversification across their portfolios, which is great to weather the various storms that can happen in financial markets.
And Tim, compared to sort of Australian residential or Australian commercial property, how does global property stack up?
Well, the fundamentals are basically the same. What we're looking for here is yield, so the rental yield, and we're looking for the full occupancy over the term. Where they differ slightly, I suppose, is Australian investors have a focus on leverage, so the negatively gearing. So when it comes to the commercial side, not so much. It's less leveraged, and so there's less overlay there. But fundamentally, the basics are exactly the same when it comes to investing. You're looking for yield, and you're looking for capital growth over time.
Now, an easy way to invest in assets like global property through an exchange-traded fund. What are the key advantages of exchange-traded funds or ETFs?
Well, first of all, they're low cost. If you're paying lower fees, then everything else being equal, you'll get higher returns. Secondly, when it comes to ETFs, they're easy to trade. It's easy to get your money in, but just as importantly, it's easy to get your money out should you change your mind, should you want to liquidate your investments. So we're talking about them being listed on the ASX, which gives them T+2, settlement in 2 days' time after you trade. So that is a great plus for investors. Whereas if you invest via, say, a managed fund, there's a much longer time lag between getting your money in and then also getting your funds out. And a lot of Australian investors were burnt through the GFC where property funds were potentially frozen, unlisted property funds. So those are the main key things.
Now, the data shows that global property and Australian property actually have a low correlation. In other words, they don't move in the same direction at the same time. So when you're constructing a portfolio for your clients, do you look sort of 50-50 between local property and global property? How do you put that sort of portfolio together? That's
a great question, Paul. At the moment, we are 50-50, but the reasons it's not always the case. So the things we look for are the fundamentals of those overseas markets different to the Australian market? So if we think the outlook for overseas is better, then we will go overweight in that split, and if the reverse, we will go underweight. The other overlay you need to be conscious of is you are exposed to currency. So when you're investing in international property, you do have that currency overlay. So if your view is that the Australian dollar is going to strengthen, particularly against the US dollar, then your investments will suffer as a result of that. So it comes down to your outlook for both the currency and also the underlying fundamentals for both of those. But as a general rule, a 50-50 is a great place to start and then move from there depending on your views.
And finally, when thinking about property in your client's portfolio, how do you actually work with your clients there?
Great question again. Effectively, we start from an asset allocation basis. So our most important discussion with our client is work out how much growth and how much defensive. So 50-50, 70-30, 60-40. Once we have that split, we agree that that's the right risk and return profile for them. We work out, okay, 70% growth. That means we need to allocate some to Australian equities, some to international equities. And the third major asset growth class is property. And so the three of those will make up that combination. So once we work out that right percentage, then it's a matter of finding best of breed investments to match that requirement in the portfolio. For us at the moment, most of that is via passive ETFs, low cost, and it fills that slot both on the international side and the domestic side. And again, that harks back to that earlier question of the split between the two. But that's how we approach the overall portfolio for our clients, and then on an ongoing basis, review it back to that target asset allocation.
So summing it all up, global property is an asset class, so much opportunity, it gives you diversification offshore, attractive yield, but also the low correlation with Australian property means that it's an ideal asset for your portfolio, and an exchange traded fund is a really easy way to actually access it. Is that the way that you see it in a nutshell?
Couldn't put it better myself, Paul. It should form a core component of clients' portfolios. How much of that percentage will change over time, but it should always be considered at least a portion of a client's wealth portfolio if they're going to optimise the diversification of their portfolio.
Tim, thanks for joining us.
Thank you, Paul.
That was Tim Mackay from Quantum Financial. I'm Paul Rickard. Thanks for joining us.